In this session, we would be discussing about the usage of the value at risk as well as the concept of risk budgeting and apply them to the investment management industry. Because value at risk we have seen as a part of computing the market VAR or value at risk compared to credit VAR, operations VAR. So we talked about the various value at risk fundamentals. So how do I use it when it comes to the investment management space? And it also goes to the extent of looking at how it differs with respect to various features like horizon, turnover, the time periods, and for an investment decisions in hedge funds, what is the application level of VAR, and various definitions associated with the risk, and finally looking at how VAR can be helpful in let's say planning, investment planning, or how is it helpful in terms of compliance checking, monitoring, all these kind of activities. So we just get started with that process. So initially, the first thing I would like to discuss about is the concept of risk budgeting, wherein the intention is fairly simple. You identify the various risk exposures and come out with a quantitative measurement for each one of them. So, at an organization level, identify the risk capital that is required based on the risk adjusted return and allocate this risk capital which has been designed at a firm level to each individual portfolios or individual positions. You allocate the organization level risk budget, and after that comes the risk monitoring or the tracking part. Now here comes the difference depending on whether the entity is a buy side entity or a sell side entity, the risk management framework differs. See, when we talk about the sell side, who are generally the participants who are selling instruments, right? Who are not investing but who are trying to sell instruments, like banks. They try to sell their products. They all come under this sell side of the investment management industry, and they have been using a lot of techniques earlier. From long time the banks are using value at risk as a process. But when it comes to the buy side, people who buy those instruments, so they are the investors. And investors very recently they started using this value at risk mechanisms to protect themselves, but generally they get into the mechanisms like diversification, portfolio construction. These are some of the things which generally the buy side of the market gets into. So they have been using the portfolio as a mechanism to diversify rather than understanding the VAR and setting limits based on the VARs and those sides. So it used to be majorly from a sell side itself, but what we could typically see otherwise as differences is from a bank standpoint or from a seller standpoint, they want very quick. They want to sell out their instruments as quickly as possible. So for them, the VAR has to be more and more measured on a short-term basis. Whereas from the buyer's perspective, once they invest, once they make an investment in a security or an asset, they would like to hold it for a slightly considerably longer period of time. So that is where they require the estimate of risk management more on a long term basis rather than on a short term basis, right? And here the banks, the sell off, the turnover, it has to be very fast, whereas from a buyer's perspective it is much lesser. Banks use heavy leverage, so the risk associated with liquidities and leverages is quite higher from a sell side perspective, whereas the that kind of a risk, as an individual investor, I may not take that much of a huge leverage to hold my positions. So that's where the risk is slightly, the leverage is slightly lower from a buyer's standpoint. So the normal risk measures that the sell side goes with is the value at risk, the stress testing, which have been the traditional risk management approaches. But when it comes to the individual investors, value at risk is slightly considered nowadays. But majority is okay, how well I do the asset allocation so that my overall standard deviation comes down, or there is a lookout for making sure that the tracking error does not cross a particular limit and ensuring consistency in the investments. These are some of the things which a mutual fund manager or the investor or someone who is acting on behalf of the investor, they would be looking out for these mechanisms as risk measures. So that is where we have to differentiate between the usage of the risk measures also, like value at risk or portfolio, from whose dimension we are trying to evaluate this. Then the other dimension which I would like to look out for is the large investors, right? Naturally, as I said in the earlier slide, any investor, his time horizon is longer. The amount of leverage he would be using is much lesser. So from his dimension, a portfolio management is a very appropriate aspect, wherein he would look out for diversification, and he would also look out for optimal asset allocation, whether it's a small player or a large investor. But few things is, from a large investor's perspective, the long term strategic asset allocation is very much required, because the large investors generally they don't pull out and invest quite frequently, for the simple reason their volumes are high, which could result in liquidity issues. Probably if they want to sell off their large position, it may create severe liquidity issues, and they may have to end up selling it at a much lesser price. So from a large investor standpoint, rather than a short term tactical asset allocation process, it has to be more and more strategic in nature, wherein as per their risk plan and risk budget, right, based on the risk plan and the risk budget they have created, they have to balance the returns and the risk, and that is what is they have to create based on looking out with various indices and benchmarks, and based on that come out with a budget, and based on that do the appropriate allocation. And once they are able to identify their long-term strategic asset allocation mechanism, then they need to find out the managers who can. So finally they decided, let's say these are the various asset classes which we will invest in. Asset class 1, asset class 2, asset class 3. So they, based on the strategic asset allocation mechanism, they have decided that we would invest in these. Now, based on this, they are creating the various funds. So, they have to recruit fund managers for each of the various kinds of investments or portfolios. They recruit the fund managers, and some of them may be very active, means they do buying and selling quite often, whereas some of them will be more and more passive, which is they track a kind of an index directly without using any kind of research mechanism. Whatever may be the role which the fund manager has been recruited, there is a kind of a monitoring that happens with respect to whether the fund manager is adhering to the risk budgets or there is a wide deviation from the budget and the plan. So there is a monitoring with respect to the type of investments. Are they in line with the plan? Or risk exposure restrictions. Okay, the restriction could be you should not invest more than 30% in any, though you are doing equity investment, not more than, let's say, 30% in any sector. Some kind of restrictions with respect to the exposure will be set. So, monitoring whether the managers are going in line with the expectations or not, and also looking out for tracking error. Again, at any point in time, did this manager exceed in terms of the tracking error? So, some kind of limits are set on each of these grounds, and based on that, the appropriate action plan is being taken so that huge losses and huge deviations can be avoided, and this is sufficient as long as the investments are straightforward, not so complex. But the more and more the investments are becoming international, global, dynamic, and complex, the regular simple monitoring approaches and measurement against a constant kind of approaches, they don't work. So that is where probably simulation based models, value at risk models based on the understanding of the underlying distribution, and based on that coming out with the risk assessment becomes the need of the hour, especially if the investment process becomes more and more complex, more and more global. There is a need for coming out with a standardized and more appropriate value at risk based models. But however, when it comes to the hedge fund industry, the value at risk becomes more and more a challenging concept, because value at risk concept as such assumes that the returns on the asset follow some kind of distribution, like normal distribution or a log normal distribution. Whereas with respect to hedge funds, it is believed that the returns do not follow any specific distribution. You see that it's almost non-linear kind of returns and payoffs that can come from a hedge fund investment. And that too, the hedge funds are highly levered compared to your regular, and also they lack transparency. So whatever the information that the hedge fund manager is supplying, probably it is more and more smoothened out information. So because of more and more smoothening, it could very well happen that the volatility becomes understated, right? Even if in a particular month this fund manager has generated a loss, he will try to cover it in the next period. So in this period, while reporting, he'll just smoothen that out, show it as a small profit rather than showing it as a small loss, and finally it may result in the volatility being more and more underestimated. Now the volatility being underestimated, the risk will become underestimated. So the valuation may look like overestimate. Because of all these things, the hedge funds trying to measure the value at risk with respect to hedge funds becomes a very tough job. And that too, with respect to hedge funds, they are exposed more and more to liquidity risk. Few reasons being, one, they are not listed on any exchange, and two, the number of investors in a hedge fund is restricted only to a high net worth kind of individual. So because of that, the volumes are much lesser, which is creating a liquidity risk. So the traditional value at risk models may not be applicable to the hedge funds because of all these reasons. Also, we see that the volatility is not constant even for a small to moderate amount of time. The volatility keeps changing, and the correlations between the securities, they keep changing quite dynamically and drastically. Whereas the VAR based models, they assume that they are pretty much, these volatilities and correlations, they are pretty much constant, at least over a small period of time. But that cannot happen with respect to hedge funds. That's one more reason we see that there are huge challenges associated with hedge funds. Now comes understanding of the different types of risk. So while measuring risk, we can measure either absolute risk, which is nothing but it's a total possible loss during a period. It's in complete absolute terms, either in dollar terms or in percentage terms, but it is absolute. Whereas when I talk about relative, I always compare it to a benchmark and I look at the excess over the benchmark. Again, this excess can be in terms of dollars or it can be in terms of percentage, but anything excess is what is a measure of relative risk. Means the loss with respect to a benchmark. So the return, the actual return minus a benchmark return. This is the measure of the risk. So generally when I take the standard deviation of this is what we use the definition as the tracking error also. And in a portfolio, a couple of other risks are bound to occur. One is a policy mix risk, especially when we are choosing the weightages. If the wrong weightages are chosen to different kinds of assets, if the choice of weights to each of the assets in the portfolio is resulting in a loss, that is what we are associating it to a policy mix risk. Whereas when I talk about active management, okay, these are the weights that are assigned to different assets, but the individual portfolio manager has deviated from these allocations. Because of the deviation of the portfolio manager from the established weights, there is a possibility of some loss coming up. And that loss is what we are calling as active management. Setting of the weights, if there is something wrong with respect to setting of the weights itself, then we associate it to a policy mix risk. But after the weights have been set, if the individual portfolio manager is deviating from those set weights and trying to use his own weights to generate the return, and there is a possibility of loss from that, we are associating it to an active management risk. It may not be so serious, especially for well managed funds, because whatever the loss that can come from one active management decision could be compensated by the profit coming from the other. So there is a lot of diversification effect that can come for well diversified kind of portfolios. The impact is very small. So we don't need to really spend too much in terms of understanding this active management risk. Whereas, yeah, this is one major aspect, the funding risk. See, funding risk is more to do with meeting the obligation. See, there is a possibility that at any point in time, the assets versus liabilities. The liabilities may go so high, but the assets are growing at a much smaller rate. So assets may not be sufficient to pay your liabilities, and the surplus, which is defined generally as assets minus liabilities, it may start falling down. Initially, probably the surplus may be higher, but over a period of time, the surplus may keep coming down, or probably it can even turn into a deficit. So, if that goes down and down and down, where the value of the assets is going much lesser than the value of the liabilities, that is where a funding risk is coming up, because I'm not able to fund all my liabilities with this assets. I'm not able to pay all my liabilities with respect to this asset. So that is where we are also trying to look at the surplus at risk. Just like the way we compute the value at risk, we also try to find out the surplus at risk, because whenever we are talking of surplus, we say assets minus liabilities. Let's say for the next period, I want to look at what is the increase in surplus. If I want to know what is the increase in surplus, we are talking about increase in assets minus increase in liabilities. If the liabilities are growing at a much faster rate compared to assets, we see that the surplus is going to fall. And that is where we are talking about the surplus being exposed to risk. So we can look at one numerical to try to understand how do we compute this surplus at risk, and what is that we need to do as a measure of holding this surplus at risk. But before we get into it, we will try to finish off even the other risk that could be existing in a portfolio, which is the sponsor related risk. So the sponsor risk is majorly is basically boiling down to the sponsor who is actually bearing the risk. So it can be associated with the cash flows, where because of the change in the contributions to the fund, let's say at this moment so many people are investing in the fund, whereas probably a year down the lane there are so many redemptions that are happening. So the contributions, probably in some cases, huge proportions are getting invested every period, whereas at some points in time, huge withdrawals are happening, creating a kind of variability. And because of that, proper planning in terms of investment becomes very difficult for the sponsor. And apart from that, there could be a possibility of economic risk, where the net income that is coming out, economic earnings that are coming out, they are varying because of market related factors or because of any other factors. All these things are adding up to the sponsor risk. So what we will do is we'll take up a small numerical to try to understand how we compute the surplus at risk, and how do I typically look out for a risk profile that is associated with a fund. All right. See, okay, we'll take up a small example. I assume at this moment a fund, right? Some fund, let's say ABC, is having the assets. Assets for a fund are the investments. Let me assume that the assets of the fund are $100 million and the liabilities for the same fund, let's say, are 75 million. So obviously at this moment I can talk about the surplus for the fund as 100 minus 75, which is 25 million. Right? And okay, and now I am expecting that for the next year, let's say I am expecting that the surplus will become, let's say, around 30 million. Means surplus will grow by 5 million. So I am expecting it to become 30 million. But at the same time, I know, let's say, the volatility of the surplus, right? In some years, the surplus was growing by some percent, in some periods, it was falling. So if I assume that the volatility of the surplus is somewhere around 8%. So what is that I am trying to look out for is how much is the value at risk associated with this position. So how do I compute that? Okay, on one side I am expecting that the surplus will become 30 million, but the value at risk for this position, if I am assuming a 95% confidence level, is 1.65, which is the Z score. Z score times volatility times your assets value or portfolio value. So 1.65 times 8% times 100 million. How much is the value at risk here? The value at risk in this case is 1.65 times 8% times 100 million. So the value at risk is 13.2. So because the value at risk is 13.2 million, in case the decline is occurring also, means there is a 5% chance, just think of what is this, there is a 5% chance that the value of this portfolio will lose 13.2 million. There is only a 5% chance that this portfolio will lose 13.2 million or above. So I need to have a backup for this with respect to my surplus. So I am expecting that my surplus is going to be 30 million. So obviously my position is positive. Even if I lose 13.2 million, I have a proper backup for addressing the same. That is where otherwise it's a decline, and I could see there is a deficit. Here in this case, anyhow, there is not a deficit, because even if this risk occurs, I have a surplus that is expected to be of 30 million. So resulting in minus 16.8, which a negative sign indicates that I'm still better off. Otherwise, there is going to be a deficit. So in this case, there is no deficit. So these are two calculations. This is the value at risk. This is the expected surplus. And this is what is the deficit or still the surplus. So this is still the surplus because it's a negative. But if I get a positive value, I am looking it out as a deficit itself. So if you look at here, we have used expected surplus minus the portfolio VAR is the shortfall. So in this case, the expected surplus was 30 minus the portfolio VAR. If it is coming out to be negative, it indicates a shortfall. Otherwise, we are better off itself. And on the same side, a slight extension for the same numerical will help us in finding out your surplus at risk. So let's talk about the same example again. Let's say I had an assets for 100 million and liabilities for 75 million. Next year I am expecting that the assets will grow by 5%, whereas the liabilities will grow, let's say, by 4%. So which means the surplus may grow because the growth rates in assets is much more than the growth rate in liabilities. So there is a possibility of growth in the surplus. So here also you assume that the volatility of assets, volatility is, let's say, 10%, and volatility of growth in liabilities is, let's say, around 8%. And you assume that the correlation between the growth rate of assets as well as liabilities, correlation, let's say, is somewhere around 0.5. So based on this information, can I compute my surplus at risk? So for this perspective, the first thing is I need to understand the assets are growing at this rate, fine, the liabilities are growing at this rate, but all I need is surplus growth rate. To compute the surplus at risk, the first thing I need to find out is the surplus growth. Okay, 100 million is growing at 5%, minus 75 million is growing at 4%. So overall the surplus is growing at 5 minus 3, which is 2. 2 million. 2 million is the growth in the surplus during this period, as under the assumption of assets growing at a certain rate, the liabilities growing at a certain rate. So the expected surplus growth is 2 million. Similarly, I will try to find out the standard deviation of the surplus growth. For that, I will go with the variance first, right? Variance of the surplus growth, which is nothing but the variance of the assets minus the liabilities. So if I am using the formula, okay, W1 squared, the variance of the assets, W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus, because I want A minus L, minus 2 into the amount of the second one into standard deviation of the first one into standard deviation of the second one into the correlation between them. So that is what is becoming the variance of the assets minus the liabilities, which is the variance of the surplus growth. So I will try to find out what is the variance of the surplus growth which will come out as, okay, 100 squared multiplied by 10% squared plus 75 squared multiplied by 8% squared minus 2 into 100 into 75 multiplied by 10% multiplied by 8% multiplied by zero point 0.5. So the variance of the surplus growth is coming out to some 76 million. The variance of the surplus growth is coming out to 76 million, and from there the standard deviation comes out to the square root of 76 million. So the standard deviation of the surplus growth is coming out to 76 square root of 76 million, working out to 8.7 million. So based on this, I can compute the 95% confidence level surplus at risk, which is nothing but my mean surplus at risk, my mean expected surplus, which is 2, plus the mean surplus, which is 2, minus 95%, so 1.65 times the standard deviation, which is coming out to almost minus 12.38, or the other way, the minus has to be interpreted with a positive. So 95% surplus at risk is 12.38 million. So what do we mean by this? I can say with 95% confidence that the surplus will not lose, the surplus will not go below 12.38 million. The loss with respect to the surplus will not be more than 12.38 million. So that is how we can compute the surplus at risk, and based on that we can try adjusting, keeping the reserves to address that, address the loss that can come up if at all the surplus is getting into a risk. Then the other dimension which we see is the value at risk can be used for wide variety of purposes today. In the investment management, it helps me in checking for compliances. It helps me in identifying rogue traders, because every individual portfolio manager is given a target with respect to the value at risk, the tracking error, with respect to different risk measures. Every portfolio manager is given a target. So if he is deviating very heavily from the allotment, what we could see is the VAR will change quite drastically for him, which means I should be able to look out for VAR on a regular basis and quickly try to catch hold of the rogue trades that are happening, person deviating very drastically from the allotted budgeted risk, either in terms of changing the positions or in terms of changing the combinations and the weightages. All these things will result in a VAR which is exceeding the limits that has been given to him, which could in a way result in catching of identifying the rogue trades much earlier, and then catching them and then looking out for the proper action plan. Similarly, VAR helps me in monitoring the risk budget. Is every department allotted risk weighted capital quite appropriately? At any point in time, am I able to see that my risk manager is exceeding the risk budget that has been set? And once I know that there is an exceeding, I should know whether it is temporary just for this day or two, or is it more and more permanent. When I say permanent, probably the manager has quite effectively or quite heavily deviated from the target, changed the allocations quite heavily. So I have to really understand whether the changes are more temporary or permanent. Are they intentional or unintentional? Are they properly authorized or not? So once I have a risk-based capital and budget in place, I can very well do the monitorings and identify the deviations quite early on before they result into mighty mega losses. They also help in assessing the similarity in the bets. Is it that all my managers are taking similar levels of risk even though they are handling equity related investments or bond related investments or real estate related investments? Let's say all of them are following similar kind of a risk approach in their own investments, then it may be a kind of a correlation breakdown kind of a scenario or a risky proposition kind of a scenario. So better analyze these things quite early on so that the action plan can be implemented accordingly. And this also helped me to evaluate whether the market as an overall thing, is it more and more volatile, and sometimes I can even reverse engineer the sources of risk. We will talk about we have already seen the meanings of component VAR, the marginal VAR. How do I use this component VAR and marginal VAR to actually adjust my investment positions depending on whether my intention is to minimize the risk or maximize the value per unit of risk? How do I use this component VAR and marginal VAR to change my investment decisions? So that kind of thing can be helpful, especially with respect to the usage of VAR. So in the investment process, it is a very powerful tool which can act as a differentiating factor today. Even for promoting themselves, the managers started using this VAR. So this at least helps in removing the ad hoc nature in the investment process, helps in choosing the investment guidelines, because the marginal VAR today can very well be used to compare and choose the assets per investment. Or we can even talk about excess returns to VAR, MVAR, marginal VAR, excess returns to marginal VAR is equating the excess return to marginal VAR is a better way to optimize the portfolio, which we have seen using the spreadsheet also earlier. So these things will really help in terms of building the investment guidelines. So that is where you see that the organizations are moving towards using a centralized risk management framework, using VAR across the various investment processes. So that is where the demand for all these things is catching up in the in the last few years. Then, when we talk about the risk budgeting from an active management standpoint, it's purely a top-down process where we look out for the firm level total risk assessment, and then we allocate it to the individual units or individual positions for various portfolio managers. So we are computing the VAR based on the targeted volatility, the sigma which the organization is willing to take up, and based on that the assets are chosen, so that at any point in time we are computing the VAR, it should be less than the targeted value itself. So a simple way to do the allocation, right, whatever may be the VAR, let's say in the earlier example we got 13.2 million as the VAR. Now that is at an overall organization level. Now there is a process. If I have to decide the weightages to each of the portfolio managers, all I am looking at is, so the budgeted portfolios So here I am taking two things: information ratios of each of the managers, right, and as well as the information ratio of the overall portfolio. What is this information ratio? It's a return that is generated by the portfolio manager over a benchmark return divided by the standard deviation of the return. So for each manager, I'll try to find out, saying this is the information ratio. For each, for the entire portfolio, I'll try to find out what is the information ratio. And then we are also talking about the tracking error of both the manager's tracking error of the individual manager, and the tracking error of the entire portfolio. And what we are saying is the weightage to each manager is nothing but you take the information ratio of the manager I divided by the information ratio of the portfolio. You multiply it with the tracking error of the portfolio divided by the tracking error of the manager, right? And what we are saying here is the tracking error of the portfolio is purely budgeted one. As a part of your risk budget, as a part of your risk plan, this tracking error of the portfolio will be decided, and you find out the information ratio of the each of the managers. So let me take a simple example to explain this scenario. Let's say we are talking about two managers controlling the whole portfolio. Manager, let's say there are two managers who are controlling the overall portfolio. Let's call them Mr. X and Mr. Y. Let me assume that the tracking error for each one of them, let's say this is 5%, this is 7%. The tracking error for each of them is like this. The information ratio. So probably the information ratio for him, I'll take it as 1. And for him, I'll take the information ratio as 0.75. So based on this, and even when I look at the overall portfolio, if I say that the overall tracking error in the portfolio is, let's say, around 3%, and the information ratio is somewhere around, let's say, 0.9, or probably it could be even better because the tracking error is lesser. Probably let me assume that the portfolio's information ratio is 1.2. Then based on this understanding, if I want to know how much weightage of my risk budget has to go to each of these portfolio managers, we are talking about here for X. If I want to find out how much weightage it has to go, we said information ratio of the first of the manager multiplied by the tracking error of the portfolio, right? The tracking error of the portfolio, let's say we are talking about 3%, right? Or let me take this, the tracking error of the portfolio divided by information ratio of the portfolio multiplied by the tracking error of the security. So it's coming out almost 50% is the weightage to this portfolio. Then similarly, here also information ratio of the portfolio of the manager multiplied by the tracking error of the portfolio divided by information ratio of the portfolio multiplied by the tracking error of the manager. So this is giving me somewhere around 26.7% as the weightage. And of course, for the portfolio, we require 100% as the weightage. So what do we say is the balance 100% minus these two, which is around 23%, is what I allocate to the benchmark itself. So even if the total does not come out to be come out, so when I'm looking at the benchmark, obviously the tracking error is zero, the information ratio is zero, no additional risk, no additional return. So I'm investing directly 23% in the benchmark portfolio. 50% of the risk capital is being allotted towards portfolio X, and 26.7% of the total risk capital is being allotted to the portfolio Y. That is the way we are trying to address the portfolio, or that is the way we are trying to address the risk capital allocation to individual portfolios, right? So whatever is the difference of sum from one is the allocation that we are doing to the benchmark. So basically on a broad scale, using a proper mechanism, we are trying to understand the we are trying to understand total organization level risk capital, which could be derived from value at risk, right? And then using appropriate weightages to allocate that capital across various portfolios based on the information ratio as well as the tracking error that are associated with these various individual securities and the portfolio. Whatever the balance that is left, the allocation is towards a benchmark, and for the benchmark the tracking error is zero, the information ratio is also zero. So this is a process that we are trying to follow for the estimation of the value at risk and the risk budgeting in the investment management. If you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.